so that we can share it. Thanks to all of you who have joined for our second state tax policy boot camp. I really appreciate you taking some time out of your day to join with us to talk about a couple of issues in state taxation. Today, we're primarily going to focus on sales and property taxes with a few other miscellaneous taxes that we bring in. I'm Vice President of State Projects at the Tax Foundation, Jared Walzak. I'll be joined today by one of my colleagues, Janelle Kamanga, who will be speaking with us a little on some of the implications of the Wayfair Supreme Court decision and some of the effects for states that are taxing remote sales and have marketplace facilitator law. So we'll get to that a little later in the session. I'm glad to have her joining us today. And throughout the course of this session, these seminars, you're going to meet all of our state team, hopefully putting some names to faces for those of you who do work with us from time to time. And we really want to emphasize that we do want to work with all of you. I know that we have a lot of legislators on these calls. We have a lot of legislative staff, and we have other people who are engaged in the policy process in the states. We as an organization at the Tax Foundation, our goal is to educate. Our goal is to be a resource to policymakers and those involved in this process. So please reach out to us if you have any questions, if we can be of any assistance to you on any tax issues in your state. We are going to have a question and answer session at the end of this session, at the end of this hour. You can ask questions at any time, but we will be getting to them at the end. If you are listening to this after the fact, as we have a recording of this program, you can feel free to follow up with us. Give me an email at jmw@taxfoundation.org, and we will get back to you and try to assist in any way, try to answer any questions you might have. With that, let's jump in to the subject of today. We're going to look at sales and property taxes, and starting with some real basics that I think a lot of people know, but hopefully, as with last time, delving into some things that might be new for a lot of people on these calls. So firstly, with sales taxes, 45 states and the District of Columbia have statewide sales taxes. So these are one of the more common forms of taxation across the country. They're common at both the state and the local level. That's true of sales and property taxes. Property taxes are way more important at the local level, but sales taxes are significant for a lot of states as well. In fact, 38 states have local option sales taxes with some variations of what that looks like. Only 5 states forego a state level sales tax. These are often called the nomad states. It's a useful acrostic to help you remember them. It's New Hampshire, Oregon. This says this wrong. Unfortunately, I'll change the slide when we show this, but Alaska, Delaware, and it actually accidentally says Massachusetts, and I apologize, but we will fix that on the slide deck. But again, there's 38 states that it should be Montana, by the way. I apologize for that. 38 states have local option sales taxes. Now, sales taxes account for 1/3 of state tax revenue. They're a really significant source of revenue. Often they are on par with the income tax, the individual income tax. And especially in the South and Southwest, they're a really major source of local revenue. Because in those areas, property valuations often are lower, property taxes often are lower, and the sales tax is a very significant portion of that pie. If you're looking, say, in the New England states, that's often not the case. The sales tax, if there is a local option sales tax, is often much lower, and there's a very heavy reliance on property taxes. Again, the sales tax is pretty important for this. The average taxpayer cost of the sales tax is a little over $1,000 a year, $1,063 in fact. And that works out to about $178 per percentage point on the rate of your state and local sales tax. Now, sales taxes are usually destination-based. And what this means is that a sales tax is imposed on the consumer, because it is a consumer tax, where they actually consume the good or service in question. Now, consumption, where consumption takes place can be complex, but the simplest example of this is something like remote sales, where you're purchasing something online or through a catalog and you're ordering it. Where it arrives, where you're actually consuming it, is where the tax is owed. And if it was untaxed at the other location, you owe use tax. You are obligated to remit the equivalent of sales tax to your state on the untaxed purchase. This has, as you might imagine, very low compliance. Some states include a line for use tax on the income tax form. Others have a separate form for this. In practice, you don't see a lot of compliance, which is why, as we'll discuss later, there's been a significant shift in the states towards requiring the remote sellers to collect and remit on behalf of the customers, the same way you would have in an in-state sale. And that was something that the Wayfair decision, Supreme Court level, helped facilitate. Now, the sales tax base. An ideal sales tax base would be on all final consumption, both goods and services, but it would not include intermediate transactions. And there's a reason for this, and sometimes this becomes complex. People say, why shouldn't business inputs be taxed? Why should we tax individuals but not businesses? Are we giving a favor to businesses or select industries? And it really comes down to what the sales tax is. The sales tax is ultimately a consumption tax. It is a tax on final consumption. And this is how it varies from between sales tax and taxes like gross receipts tax or valued added tax, a VAT. The idea here is to tax all consumption one time. If you tax the intermediate transactions, then you get to a point where the final transaction is taxed multiple times over. We'll get into a little more on that in just a few minutes as we touch a little more deeply on the base, but the goal is to avoid what's called tax pyramiding. You want to make sure that ideally all transactions are taxed, but that none of them are taxed more aggressively than others. A gross receipts tax, by contrast, and a few states have those as well as a few localities, this is imposed at every level of transaction, usually at a very low rate, but it's on the gross receipts or the gross revenues, gross sales of every transaction. So the raw materials are taxed, all of the productive activity is taxed, and the final price, the final good or service sale is also taxed. A value-added tax, which is what a lot of other countries have. European countries have these. In fact, most of the rest of the developed world uses value-added taxes as part of their tax toolkit. It can look superficially like a gross receipts tax. And I think a lot of people in the United States think that's what it is because it's taxed at every stage of production. But there's a credit or a subtraction. There's different methods, but there are ways that you eliminate the tax on all of the previous production. So you are just incrementally taxing the additional value at every stage. And that's why it's called a value-added tax. So the idea here is that when the good or service is sold to the ultimate consumer, even though it has been incrementally taxed at many points, the credit system or the subtraction or modification system yields a value-added tax that is uniform across the entire good rather than pyramiding. Now, unfortunately, sales taxes often diverge pretty sharply from what we think of as the ideal treatment. The average sales tax breadth as of last year is only 31%, with a median of 36%. Now, this is traditionally measured as a percentage of personal income, which I know is a somewhat weird measure because we don't consume, at least in every given year, all that we earn. But the idea is over lifetimes, and we're using average figures. We earn to consume. Even with transfers across years and across lives, we ultimately consume what we earn, and therefore this is a reasonably good, or at least a measure that we can transfer across states. And you'd expect, therefore, in an ideal sales tax on all final consumption, maybe not 100%, but certainly somewhere in the ballpark of 75 to 80% sales tax breadth, and we have half that, less than half that. And it ranges from 22% of personal income in Massachusetts to 119% in Hawaii. Now, 119% doesn't sound good either, right? So we've got a problem. We have a situation where in some states, the sales tax base is very narrow, and it is continuing to erode. We'll talk about why those exclusions exist and where they have come from. In other states, you look more like a gross receipts tax. You're taxing a lot of the business inputs, and therefore you have a sales tax breadth that's actually higher than personal income. It certainly shouldn't be higher. But we've seen this erosion. Sales tax breadth has declined from an average of 50% only 20 years ago to 31% today. And for the most part, states have responded to this erosion by raising the rate. The average rate was 5.16% in 2000. It's 5.99% today. And this is sort of contrary to what we think of as general tax principles, that you want broad bases and low rates. We're raising the rates to offset a reduction in the base. Now, exclusions exist for a variety of reasons. Some of them exist to address regressivity concerns. And we'll talk a little more about what that means and whether they are really effective. There's some reason to believe that some of them don't work nearly as well as intended. But these are things for like groceries or clothing, where the concern is that these will be a much larger percentage of the total income goes to these purchases for lower income individuals, and therefore for tax fairness purposes or to provide a tax advantage to lower income individuals, you provide these exemptions, and they can be very large. I mean, groceries are a significant portion of the purchases of the average person. Sometimes they're to favor certain types of purchases. You see states, for instance, exempt emergency preparedness supplies or other things that they think people ought to purchase to try to promote them. Sales tax holidays kind of fall in the same category, but they're sort of in that mix, because you might have like a sales tax holiday for back to school, where you're not really promoting it, you are trying to provide that benefit. You also see sales tax exemptions to favor certain industries or activities. I mean, there's clearly lobbying that goes on. Once you have a long list of exemptions, it's not terribly hard to add another. And individually, they may not be very large, but they clearly add up, as we can see from this continual erosion. But a lot of this, honestly, is just historical accident, especially the exclusion of services. I mentioned last week that the sales tax really begins in 1930 in Mississippi. Now, there are variations of things that kind of look like sales taxes before that. Sometimes you'll hear that West Virginia in 1921 had one, more grocery receipts tax. But the true modern sales tax begins in 1930 in Mississippi, and it is essentially a Depression era tool because property taxes weren't generating as much revenue at the time. So it's Mississippi. It's 1930. This is a time when, honestly, dry goods were the most taxed item. They were what really mattered. But it was easy to just impose this on a pretty broad definition of goods, but to exclude all services as something that wasn't worth administering and probably wouldn't raise that much revenue. But unfortunately, states continue to adopt that model, even though each state has its own approach. To a significant degree, we see states taxing taxing services at a very low rate. There are very few of them are included in sales tax bases. We tend to instead see primarily goods, and again, a narrowing range of goods. Now, this is a problem because we have seen a dramatic increase in services as a percentage of personal consumption in recent decades. In fact, services are now 2/3 of overall consumption in this country. They're very near 70% at this point. Not all of that would be likely to be taxable even in a perfect world, but most of it would be. A lot of it would be, and we're missing that. And that's important for a number of reasons. We mentioned the regressivity concerns. This is usually one of the biggest concerns in a sales tax, and it's a legitimate one. Compared to some other forms of taxation, especially income taxes, sales taxes can be regressive. Now, we need to define what that means in this context. It does not mean that low-income people pay more in sales tax than high-income people. They do, of course, pay less because it is measured by sales, but they pay more as a percentage of their income under certain circumstances, because lower-income individuals are going to consume more. They're not investing nearly as much, which, of course, wouldn't be subject to the sales tax. So, there's two reasons really why this regressivity occurs. One of them is just that, that more is being consumed. The other is what we put in the base. And that's where services really come in. And that's where we can make an impact on, the regressivity element of this, and also the stability of the sales tax. Services are consumed at a much higher rate by higher income individuals, by the middle class, the upper middle class, and truly wealthy individuals. They're purchasing a lot more services, more experiences than lower income individuals. And we're excluding a lot of it. And it's really an accident. It wasn't something that was a conscious choice to exempt. It wasn't intended to help wealthier individuals, but it's where we are. And most states have really resisted a significant expansion to the sales tax on services. Sometimes it's conceived as a new tax. I would argue it's not. It's right sizing and modernizing what the sales tax is. And of course, doing this on a revenue neutral basis is great. There's an opportunity to broaden the base and lower the rate for everyone. And that does shift some of the burdens in a more progressive direction, which I think can be very important because it's a legitimate concern within the sales tax, that regressivity. I'll talk a little later about how the sales tax is in many ways a very good tax, one we want to work. And that means we need to make sure that it works for everyone. Now, there are some exclusions that are meant to address regressivity that frankly don't work nearly as well as expected. And one that I think might surprise a lot of people is the grocery exemption. This just seems like it would obviously reduce regressivity. And in fact, most states clearly think so, either exempting groceries or taxing them at a lower rate. But the key here is that by federal law, SNAP and WIC eligible purchases are not subject to sales tax. If you tax those, you lose a lot of benefits. I mean, it creates a mess. So every state follows the federal government's guidelines and does not tax SNAP or WIC purchases. And it turns out when you look at the research, once you exempt those, a further exemption of groceries above and beyond that actually isn't progressive. In fact, there's multiple studies that show that, putting it back in the base and doing an overall rate reduction would do more for lower income purchasers than the rest of the grocery exemption. It turns out that the amount you spend on groceries once you're out of the SNAP categories tends to actually scale quite well with income. And in fact, a lot of the purchases of food that are made by lower income individuals are currently taxed anyway, because prepared foods are subject to tax. Not only are they subject to sales tax, they're also often subject to meals taxes. And for some reason, I think often policymakers still think of prepared foods as a luxury. We're thinking about takeaway, perhaps. But the rotisserie chicken at your grocery store is also prepared food. A lot of the hot deli foods, and of course, it does include other things like fast food and all of that as well. That not only have the sales tax, but also might have a meals tax. And I think it's a real misnomer to think of these as luxuries, especially for lower income working families. These are often very affordable foods. They're prepared. It takes very little time, and they can be a significant portion of overall food consumption. And yet they're subject to excessive taxes, while the raw ingredients that might go into a more gourmet meal are exempt. It's not a policy that has worked nearly as well as many have intended, and it's honestly a pay for that policymakers should think about. I know it's difficult to get past that hurdle, but to say maybe this isn't working and maybe we can do something to make a better overall sales tax. But it is really important that we think about modernizing the sales tax overall. Often we fail to tax obvious substitutes, both goods and services. We tax the DVD, we don't tax the streaming service. We tax the lawnmower, but we don't tax the landscaping service. Some states, North Carolina is a good example, have gradually, incrementally gotten towards this in a way that in their mind doesn't burden a lot of new businesses or different types of businesses. So they tax labor services where there's already a taxable component. Say car repair or installation or maintenance, you're taxing the sale of the appliance, you're taxing the parts for the auto repair, we'll tax the labor too. I think that's a good first step. I think we can go farther. Broader modernization has proven really difficult, but it eventually needs to happen. Digital goods are slowly being taxed, but we need to probably go farther if we're going to avoid this continual erosion that will make the sales tax much less stable and probably just a much less effective overall tax. And again, on business inputs, we want to make sure that intermediate purchases like raw materials, parts, business utilities, engineering, contractor services, marketing, distribution, the whole line. If these are taxed, then the final good and service, when it's taxed as well, leads to that multiple layers of tax being embedded. It costs more for the consumer at the end. It also makes some changes in how the tax works. The sales tax, like I said, is destination based. The incidence of the tax is where the consumer is or where the consumption takes place. But when it's taxed on the business inputs, it's taxed where the business is located. It makes the state less competitive. Under a normal sales tax, it doesn't matter where you're located for sales tax purposes because it matters where your customer is. That's where the sales tax is imposed. So your state isn't less competitive for business activities, for manufacturing, for instance, because of your sales tax. But it is the moment you tax a lot of these intermediate transactions because those are being taxed where the company is using them. And that utilization is what's raising their costs, makes them less competitive compared to their peers. This is also more of a problem for less vertically integrated firms. And what I mean by that is that there are some companies that bring a lot of their activities in-house. Their engineering's in-house, their manufacturing, their HR, their payroll, their accounting, their marketing, packaging, whatever it is, it's all done in one company. They're vertically integrated. Some companies, a lot of companies, especially those that are smaller, it doesn't make sense for them to specialize in all of these things. They have what they're good at, and they contract out for the rest, which means there's more points of exposure to the sales tax if those inputs are taxed, which means that the really large companies can often escape a lot of the burden of the pyramiding of business inputs and their smaller peers are often taxed much more heavily. Again, not really an intended policy of taxing business inputs, but something that arises from it. Something I think policymakers need to be aware of. States have been trying for decades to remove inputs from the base for the most part, but it's slow, arduous work. And some states have pushed in the opposite direction, unfortunately, thinking, well, why shouldn't businesses pay their fair share? And I would just say the sales tax is not a business tax. When you do this, it's raising the cost for the consumer at the end of the day. And it really gets away from what the sales tax is as a tax ultimately on consumption. Let's talk very briefly about sales tax sourcing. Like I said, sales taxes are typically destination-based, but that's not always true. There's 7 states that generally use origin sourcing: Arizona, Illinois, Missouri, New Mexico, Tennessee, Utah, and Virginia. And some use mixed sourcing, which makes things incredibly complex. In California, the statewide sales tax is origin-based, but local sales taxes are destination-based. Why? I don't know. I mean, some of these things have been around for a very long time. Some states have different rules for different types of transactions. But sourcing actually gets uniquely complex with services, and it's important to set these rules. Is where a service is performed or where the service is received what matters. And we talked about this with corporate taxation as well. Sourcing of service income for businesses matters for those sort of taxes, but it matters here too. And you have to ask questions. If it's where the benefit's received, which is usually where it is for sales tax and where it should be, that's destination sourcing. Is it the address of the purchaser? Is it where the benefit's received regardless of that address? In the case of a business purchaser, what if the benefit is received in multiple jurisdictions? I mean, we're using Zoom right now. Zoom is a paid service if you have large enough accounts. So let's say you're a company that has a Zoom subscription that is used by offices in 5 states. And let's say you're paying sales tax on that. Software as a service. So is it sourced to your corporate headquarters where you probably purchased it? Is it sourced in some sort of prorated way across all of the offices that use it in all those states? These are questions states need to answer, and obviously simplicity really helps here. And if you do this wrong, you can also get multiple taxation where different states have competing regimes that tend to overtax these things. So that is, I think, a really important thing to consider as well. And one that's under considered is just how you source some of these transactions. Now, within the sales tax, unity and uniformity is really important. Now, what do I mean with that? Within a given state, you have 2 questions. One, assuming there's a local sales tax option available, is the base identical in all those jurisdictions? Is the decision of what is and isn't taxable the same at the state level and in all of the local jurisdictions or not? That is the uniform base question. The other question is one of unitary administration. Who collects the sales tax? Who administers it? Who does the audit if that's necessary? That can be the state, or it can be all the local governments as well. And obviously, from the perspective of businesses, it is far easier to work with one entity. It is very complex, especially for businesses that have sales into multiple jurisdictions, to determine what is in and out of a base in different jurisdictions. Not too hard in one state, and states tend to have the resources and the software and the tools available to determine what's in their base. But if you have to deal with dozens, maybe hundreds of local jurisdictions as well, this gets really complex. And that's especially true for remote sailors, which Janelle will talk about in just a minute. But it's something that states need to work on. The vast majority of states have both unity and uniformity. Those that diverge from it in some way are Alabama, Alaska, Arizona, Colorado, and Louisiana. Now, Alaska, this is the case because the state doesn't have a sales tax, but local governments are allowed to impose one. And while they are actually banding together in some respects to try to address remote sales taxes, they, for the most part, can go their own way on this. There's no unity imposed on them. Some states like Arizona have made enormous strides in how they deal with this. They're getting very close to having unity and uniformity. States like Alabama, Colorado, and Louisiana are all making progress, but have a long ways to go. And right now, you can have a situation where maybe a remote seller could theoretically have to register in every jurisdiction in which they have a sale. Pay a business license fee in that jurisdiction, remit sales tax to that jurisdiction, figure out what's in the base, because it could be a completely different base than you have at the state level. And this can be true even if they only have one sale into the state. You'll hear in a minute some of the thresholds that states have generally adopted for remote sellers at the state level, but there are local jurisdictions in a few of these states that have said, if you are liable for the state sales tax, you're liable here, even if you have $1 worth of sales in our jurisdiction. And for the most part, that's not actually happening. There's not a lot of compliance on it, but it's a huge issue. And a lot of states have joined what's called the Streamlined Sales Tax Agreement. Janelle will mention that a little more. This tries to address it. It creates a uniform set of rules. It creates some common definitions across states. In fact, it even has common definitions for the items in a sales tax base. Now, it doesn't say that every state's sales tax has to be identical. You can create whatever base you want within Streamlined Sales Tax for the most part. But if you say that you are taxing X type of good, that good has a definition that is the same in every state that adopts a sales tax that includes that good. And the idea being that a seller can make one classification for that good that applies to every state. And they don't have to say, well, I think I'm a digital good in the following 10 states, but I actually am classified as something else in these states. It simplifies that. It's something very good. States have, in more recent years, especially post-Wayfair, resisted joining it because, in many ways it was intended to show that the states were cooperating to be able to get federal legislation that would allow remote sales tax collection. And once the court said you can do it, a lot of the just motivation perhaps for doing that sort of cooperation just withered. With that, I think I'm going to go to the next slide and turn it over to my colleague Janelle, who can talk a little about the Wayfair decision and some of the remote sales tax authority that state and local governments have now.
Thanks, Jared. So yeah, I'm going to talk a little bit about the Wayfair decision. It's no secret that the South Dakota v. Wayfair Supreme Court case was extremely impactful, but in order to fully appreciate it, it's important that we do cover some background. So the earlier landmark cases of National Bellis Hess and Quill ruled that only businesses with some kind of physical presence in a state had the minimum contacts necessary to let states impose sales tax collection and remittance obligations on them. Quill in 1992 reiterated that prohibition, and while many at the time expected some kind of federal legislation to follow, none ever did. However, the growing popularity of internet sales turned the sales tax landscape into something of a Wild West. Not wanting to miss out on a significant amount of revenue, states got creative. They interpreted physical presence as loosely as they could. This birthed ideas like click-through nexus, cookie nexus, and other techniques that created complexity while not serving their original purpose, which is taxing online sales that took place in a state. South Dakota v. Wayfair overturned this physical presence standard in June of 2018, allowing states to require out-of-state sellers to collect and remit sales tax. And while Wayfair didn't give precise rules as to how states were supposed to set up their remote seller requirements, the decision did highlight several elements of South Dakota's law that allowed it to fall within constitutional constraints and limit the burden on sellers. So the first item in what we call the Wayfair checklist is providing a safe harbor to protect small sellers, a threshold of minimum sales volume into the state, under which a company has no obligation to collect and remit. A well-designed safe harbor should first take the size of a state's economy into consideration, with a higher de minimis threshold in larger states. It should be denominated in gross sales, not transactions, to avoid the possibility of imposing burdens in excess of profits. It should be calculated using taxable sales under the state's own sales tax base, and it should avoid notch effects, where if you exceed the safe harbor, then it imposes a retroactive collection obligation on transactions that were already completed. South Dakota's law set a $100,000 threshold, and many states have copied that. I should note that Kansas is the only state so far that has not instituted some kind of safe harbor provision. The other necessity, as Jared was talking about, is unity and uniformity. In the case of sales taxes on online sales, a state that lacks a uniform base and central administration could create an overwhelming burden for sellers and marketplace facilitators. Most states have this covered, but as Jared said, there are a few outliers. Arizona's state base differs from its local bases, although it has made enormous strides forward in that regard. Arizona is definitely an important recent success story because it's been doing the hard work of shifting to unitary administration from what had been a patchwork of local administrators. Alabama has a unified base, but it lacks unified administration. The state has tried to get around this problem by letting remote sellers pay a simplified seller's use tax. That means that they pay a total of 8% sales tax across the board instead of paying the state rate of 4% added to each specific local rate. Since that simplified rate is lower than the average rate and it eliminates the need to comply with locally administered sales taxes, a lot of sellers might be satisfied with this, but in some places like Saginaw, where the combined rate is only 5%, residents actually end up paying more in sales tax for online purchases than they do from physical retailers. The state allows taxpayers in cities like that to apply for an overpayment refund, But this requires the taxpayer to document every transaction for which a refund is requested, which is a large compliance cost for someone who is already taxed excessively. This raises constitutional questions by discriminating against remote sellers. Colorado and Louisiana have the unenviable position of having neither uniform bases or unitary administration. Colorado is trying to move in a better direction, still has some counties holding out on simplification, and Louisiana has also been making great strides forward to fix at least the administration part of this. And it has been working to put all sales tax administration under one roof. It also has taken the route of providing lookup software and a payment portal in order to ease the burden for sellers. Now, Louisiana started from scratch to make this system, but many states could latch on to a system that already exists. If they're party to the streamlined sales and use tax agreement, like Jared just mentioned a few minutes ago, states have access to free software that tracks local sales tax rates and bases, and it gives sellers one place to make their payments. Almost all states that levy a sales tax have acted on their newfound ability to require remote sellers to collect and remit, although Florida and Missouri have held back. Both states are considering bills aimed at this issue in their sessions right now. Almost all states with remote seller requirements have also acted to give marketplace facilitators the same obligation, although Kansas is currently deliberating on a bill to address that this session. Marketplace facilitators are platforms like Amazon, Etsy, Google, and the iPhone and App Store, or even Postmates that facilitate sales from a variety of sellers. Requiring marketplace facilitators to collect and remit cuts down on administrative costs, and it also broadens the sales tax umbrella to include sellers who wouldn't have surpassed the safe harbor on their own, and it reduces compliance burdens by centering responsibilities in larger companies who are in a better position to handle that process. But states should be careful when including marketplace facilitators, because if their definition of a facilitator is too broad, they can end up capturing payment processors like credit card companies or platforms like Craigslist that act as a platform without facilitating payments. Even in the case of a facilitator that acts as both the platform and the payment processor, a seller may be better positioned to handle the collection and remittance on their own, and well-designed laws would provide flexibility to accommodate that. Now that states have walked through the door that Wayfair opened, they should take care to remove the more creative nexus requirements that may still be on their books, and take care that in the process of collecting revenue that they have a right to, they do not overburden small sellers with complicated regulations or difficult compliance processes. States should keep the ultimate goal in mind, and that's a broader, equitable, more stable, and legal resilient sales tax base.
Thanks, Janelle. Appreciate that. And we're going to jump on to the just a few questions as we wrap up the sales tax piece of this about the broad economic considerations of a sales tax. As I alluded to a minute ago, the sales tax is actually one of the most economically efficient taxes out there. It's way more economically efficient than the individual or corporate income tax. This goes back to some things we discussed in the previous session, where a sales tax is just on consumption. And because it's usually destination sourced, there's not nearly as much motivation to move investment with a sales tax, especially a well-designed one, as you would with other forms of taxation. It's not taxing capital and labor in the same way that other forms of taxation are. So economists tend to like these taxes. They are fairly neutral. They have relatively little impact comparatively on economic decision making. These are all good things. They're also a highly stable revenue stream, especially during economic downturns. Consumption doesn't change nearly as much as does income, or especially corporate income or business activity. Corporations in particular can have negative revenue, obviously, during an economic downturn. Consumption will still take place, and you can see that graph from the Great Recession, where sales taxes are the most stable of the major taxes. Now, this has not been the case during the current downturn. They've actually been very stable. We saw a huge drop in April, late March and through April, and they've recovered nicely. In fact, sales tax collections have been up for the rest of the year above what was projected in all of the subsequent months. People have, in many ways, actually purchased more that's subject to sales tax this year than they did previous years. Some of the things, the services that aren't often taxed, aren't really viable during a pandemic year, and a lot of purchases have been made. So it's been a stable tax, but the income tax has actually done really well this year, which is unusual during an economic contraction. And a lot of that owes to the federal aid that has propped up the market in various ways, has kept jobs in place, has kept unemployment compensation very high, which has been another source of income tax revenue. And very importantly, the fact that in this very unusual circumstance, the stock market has just done incredibly well. Usually, of course, capital gains plummet during a recession, and that's why sales taxes are good in this time, and usually income taxes are doing terribly. This has been an unusual event where the income tax is doing quite well. Sales tax is doing great too, but the income tax is overperforming by a significant margin what we'd expect. This won't be normal. This is not how a normal recession works, because really the economic contraction that we've experienced is related to epidemiological factors more than economic factors. So generally speaking, despite this year, it makes sense to think of the sales tax as a highly stable revenue source, more so than income taxes. But that regressivity is a legitimate concern, and it can be ameliorated with modernization. The chief concern, I think, is base erosion. We just see less and less actually subject to the sales tax, which means higher rates to offset it, or it means shifting to other taxes that may be less competitive. It can be particularly bad for local governments that often have limited tax authority, and the sales tax is a major piece of their puzzle. So addressing that for equity purposes, for revenue stability purposes, for reliance on a good tax, I think is going to be necessary for states in the coming years. With that, let's move on to property taxes. Now, property taxes are imposed almost exclusively by local governments. They comprise 72% of local government revenue statewide, state tax revenue statewide, and that's 31% of combined state and local revenue. Now, there are a few statewide property taxes, often on particular classes of property, but this is almost exclusively at this point in time a local tax. And there's a broad typology of property that we can consider for potential tax purposes. The first is real property. This is land and structures. The second is tangible personal property. That includes machinery and equipment, anything that can be touched and moved. The class technically includes everything in your home too, your furnishings, your appliances, all of that. States have over the years exempted that. They've provided exemptions for personal possessions. So for tax purposes, tangible personal property now essentially refers to business property like machinery and equipment. And then intangibles can also be considered property. That includes patents and trademarks and potentially even financial assets. And states have, for the most part, said, well, these should not be subject to property taxes. This looks like a wealth tax. There are some constitutional constraints. There's lots of issues in dealing with this. But there are states that have some intangibles in their base. So be aware that that's out there. We will, for the most part, be talking about real and tangible personal property in the coming slides. Now, tax rates in property are usually expressed in millages. This isn't always the case, but usually they're millages, which means that it's dollars per thousand. So 10 mils is essentially a 1% tax. To make it even more complex, though, they're imposed on a tax value that incorporates often an assessment ratio and the assessment value. You can't just compare across states. When we say that one state's income tax is 6% and another 7%. Yes, the bases might be a little different, but this still gives us a rough approximation of the difference in those states. When you hear about property tax rates, you cannot make any such comparison. Sometimes they can appear to be an order of magnitude higher, and that's not actually the case, because either the assessments are set based on some price long ago and are not reflective of actual market value, or because they have an assessment ratio where they include maybe only 10% of the value of the property as the amount that is subject to tax. It's a kind of weird approach. It is not one that promotes understanding of the tax code. And I think that's a problem within the property tax, that we've made it more complex than it needs to be. To understand that a little, let's talk about assessment and valuation. The standard approach is the market value of the property, and that's typically according to what's called the highest and best use. What this means is that your property should be valued based on what it could be used for, what it would sell for to some degree based on what use someone could put it to, not the use you have chosen. You might have chosen a less efficient use, economically speaking. That's not the value of the property. But a lot of things can go into determining market value, and some of them diverge pretty sharply from what's actually market value. Sometimes assessors are looking at comparable sales. Sometimes they're looking at the cost method, taking the value of the land plus the cost of reproducing the structures and the improvements. Sometimes, especially for business property, commercial property, they're looking at the income method, how much revenue you'd expect to receive if you were renting out the property. Agricultural property in particular is often valued according to agricultural use, and this is a form of farm relief. Often the value of farmland far surpasses its actual use as farmland, especially if you're maybe near the suburbs. It would be more cost efficient perhaps to redevelop that, put in a shopping plaza, put in some residential developments. But policymakers have often wanted to preserve the family farms, and therefore they have said, well, we're going to value it by maybe complex formulas about what crops you're growing, what the soil quality is. We're going to bring all these factors in to say, what is its use value to you? Now, there's some research that suggests that this doesn't do a whole lot to actually preserve the value of farmland, but it's very much embedded in certain states, especially those that are, sort of in the Midwest, in the grain basket. In some respects, this is a very embedded practice. Most states require that property be reassessed every 2 to 5 years, but there's a lot of variation. There's a handful of states that don't require any schedule for reassessment, and a property can remain at the same assessed value for years, even decades. I grew up in Pennsylvania, and there are still 1 or 2 jurisdictions in Pennsylvania where the last assessment took place before the moon landing. I feel that was a long time ago, and that perhaps at some point we should have revalued those properties and put them on the books at a higher value. Because when you have this, you either have to take currently valued properties and somehow back cash that and say, sure, it's worth $400,000 today, but what would it be worth in 1965 dollars, which is not a great practice. Or you just have radically different values on very similar properties, and therefore radically different effective rates on those. Often also, if you make a substantial improvement to the property, that triggers a reassessment, which if you have a really long assessment cycle, it can discourage those sort of improvements because you've got to pay more taxes years and years earlier than you would if it was a little more regularized. So, there's not a set schedule, is it 2, 3, 4 years, but you want to make sure there's a regular schedule, whatever that may be. I mentioned assessment ratios. These are important in the sense that you might only be assessing 10 or 20% of the value. They often come into play for what is called split roll, where different classes of property are taxed at different assessment rates. You often have this, for instance, with commercial property being taxed at a higher assessment ratio than residential property. You may have industrial property at a different rate. You have all of these different things that can come in, because you've got, like I said, commercial, agricultural, industrial, tangible utility property, way more, all of these classes, and you can do them at different rates. This can be pretty uncompetitive, especially when it gets out of hand. In Colorado, voters recently adopted a change to their constitution that will freeze some practices they had that was initially intended to create maybe like a 30 to 40% premium on commercial property, but ultimately yielded what was about to be a 600% premium, which just is really out of control and was very difficult for a lot of businesses. And it's important to note that in many states, rental property is commercial property, not a single home, not a detached home that might be rented out, but apartment complexes, things like that. And we know there's a lot of studies on this that most, if not all, of the costs of property taxes on those properties are in fact paid by the renter. And while there are clearly a lot of truly high income renters, the median renter is lower income than the median homeowner. And they're often effectively paying at commercial rates that are sometimes multiples of the residential rate. And it's an inequity. It's really a confusing approach that some states have not addressed yet. Now, some states have what are called uniformity clauses. They don't allow this sort of distinction. They require these uniform rates. But most states allow some distinctions, and a lot of states have what's called a homestead exemption. There's a certain amount that's excluded from taxation for a primary residence. It wouldn't be applied to additional residences. Now, property taxes can be sometimes an unpopular tax, even though economists usually think they're a pretty good tax. And a lot of policymakers are concerned about rising property taxes. So there are a number of ways that legislators have tried to limit them over the years. They can broadly be considered as 3 types. There's a lot of variations: assessment limits, rate limits, and levy or collection limits. The purpose of an assessment limit is to constrain tax increases arising from rising home values rather than conscious rate hikes. So, a property owner might be wealthier on paper because their value of property has appreciated, but their income flows, their ability to pay higher taxes may not have risen proportionally. They've just lived in the house for a long time and it's risen in value. Assessment limits seek to cushion that blow. They limit the amount by which rising property values can increase exposure to taxation. Number of different ways they can do this. They can freeze or roll back assessment increases. They can set a cap on the maximum assessment growth per year. The problem with this, of course, is that it encourages long incumbency in homes. If you have two identical homes and one of them someone's lived in for 20 years and there's another across the street that was just purchased, the one across the street, even though it's the same, is being taxed at a much higher effective rate than the other. So it discourages moving, it discourages downsizing, it discourages improvements on the home that might trigger a reassessment. It discourages a lot of the economic activity that we want around the housing market that creates the appropriate liquidity. And it's just arguably really inequitable. In fact, in some cases, it has created significant racial disparities. There's a handful of states where court cases have, it's not always on assessment limits themselves, but on, say, long times where no reassessments took place, where the courts have come in and said, you have long established wealthy communities, maybe predominantly white, that haven't been reassessed for decades. And then you have newer construction that is largely lower income and may have a higher propensity to be occupied by racial minorities that is assessed much more recently, and therefore bears much higher effective rates. In Massachusetts, some decades ago, you had situations where, old Bostonians living in mansions were paying less, not percentage-wise, but in actual dollar amounts than low-income African-Americans in a few parts of the city. And the court said this can't stand. Assessment limits aren't usually going to go quite that far, but they can create these problems. Prop 13 in California is one example of this. It is limiting the growth of property taxes, which might be a good thing, depending on your point of view, but it does it in a really inequitable way. There are two other approaches. One's called rate limits. These are intended to restrict consciously adopted tax increases. They limit the authority of a local government to adopt a tax increase either by capping the amount of the increase in a given year, requiring voter authorization to raise taxes, or freezing the rates outright, or just putting an overall cap on what the top rate, the rate can be. There are ways that policymakers can sometimes get around them. They can, for instance, change the assessment. There's limits on this, but they can assess the properties as valued more to try to get around the cap. And you see some gamesmanship on this. Then levy limits, they're also called revenue or collection limits. They're concerned with the actual amount of revenue raised. They have rollbacks or obligate rate reductions to ensure that collections do not increase in aggregate above a given amount. And that excludes new construction. If you're bringing new construction in, that's supposed to increase the base, but the rest of the growth, it can grow maybe at some percentage of, inflation and, all of this. But if it increases above a certain amount, you need to have a rate reduction or a rollback to prevent that increase in property values from creating a significant property tax hike, especially since the services that the local government likely provides doesn't necessarily increase substantially when the value of properties increase. And then there are circuit breakers. These are targeted relief for low-income elderly taxpayers, usually as a percentage of income. They place a ceiling on property tax bills. So this addresses some of the concerns of the assessment limit, but it does it in a way more targeted and limited way. For states that have an assessment limit and might think, well, maybe we should have a levy limit instead, maybe that'd be more equitable, but they still have concern about what if you're pricing a fixed income person out of their home. Combining a levy limit with a circuit breaker can accomplish a lot of the policy purpose without having some of the perverse incentives that are created by the broader assessment limitation. Quickly, I mentioned that tangible personal property is often taxed. Now, TPP is property that can be touched and moved. It's like equipment, machinery, inventory in some cases, and furniture. Taxes on TPP tend to disincentivize investment and distort economic decision-making, especially when some TPP receives preferential treatment. You can have really high effective rates of taxation on certain types of investments that can discourage them, can move them. And this actually really has a significant impact on where certain types of businesses locate and expand their facilities. We have a paper which goes into some examples showing that what seems like ordinary property tax rates can be an order of magnitude higher in some cases when you apply it to tangible personal property, just because of the way that it's imposed. TPP is actually also what's called taxpayer active. The taxpayer themselves must determine which property is taxable, determine its acquisition value, ascertain the depreciation that it's had over the years, and then remit the tax on it. There's a lot more complexity, and especially for small business owners, sometimes the tax burden is relatively low, but the compliance costs are quite high. So there are some ways the states are responding to this. But first, I'll say many states offer credits against TPP to incentivize economic development, especially for new or expanding facilities. because they're recognizing there's a problem. They're recognizing this isn't what property taxes are ideally for, and that it's really disincentivizing activity, but they're doing it just for select firms rather than perhaps addressing this wholesale. But states are starting to get this right. They're expanding de minimis exemptions, taking some taxpayers entirely off the books. Someone who's paying a small amount but is spending hours trying to comply, just exempting, just maybe the first $10,000 worth of TPP, not even having to try to assess or do anything with it, can take probably 70-80% of all your taxpayers off the rolls. 100,000, you're probably getting to 90% in most states. It's going to vary a little, but there are ways to just reduce these compliance costs for the smaller businesses. Some states are phasing it out over time, trying to allow local governments to find ways to replace that revenue. Some are offering a local option to exclude TPP from the base if a locality wants to be more competitive on those scores. This is something that more states should look into. It really isn't ideal within the property tax, which is what we'll sort of talk about in a second. I'm sorry, I pulled up a slide that came out of order, and I apologize for that. A few challenges here. But I mentioned the circuit breakers. I want to talk about some tax exemptions real quick, and then we'll get to the economic case. You have property that's owned by government, nonprofits. These things tend to be exempt. So universities, churches, hospitals, things like that. That can be a genuine issue for local governments that have a lot of property that's like that. And there are ways that local governments try to raise revenue around that. They have payments in lieu of taxes, pilots in some cases, but it is a significant issue. You also have abatements for economic development purposes that can carve out your base, and you have tax increment financing that can paper over uncompetitive rates in some cases by allowing some businesses to essentially collect the taxes themselves and keep a portion of them. These tax exemptions often aren't terribly ideal, and they're papering over broader problems. So with that very brief aside, going back to the economic case, there's good reasons why we have property taxes. They largely conform to what's called the benefit principle of taxation. You're paying for the services you receive. The value of your house is actually a pretty good proxy for how much use and how much value there is for roads and police and fire and other services that are provided by local governments. Even the education system, regardless of whether you have children, because property taxes usually pay significantly for schools. We all know that a house in a good school district is worth more. And you're paying for that through your property taxes. You're getting value whether or not you have kids in school. So this benefit principle actually applies pretty nicely. It's also what's called a captive tax. The base can't be moved. It's hard to evade. It's hard to plan around. Economists like that because you really don't want the tax code changing behavior any more than possible. Property taxes don't do a lot of that if you're designing them well. Like I said, you put an assessment limit in, you do a few things, you can make this way more complex. But on the most part, this is good. It's also a transparent tax. This has pros and cons. Transparency is good. The problem is that the property tax is pretty transparent. People know what they pay in property taxes. Other taxes often aren't. People have no clue what they paid in sales taxes last year. They may not even know what they paid in income taxes last year. It was withheld. They just don't know. They know what they paid at the end of the year. They may have received a refund and thought that, in some ways, wow, I'm getting money back. Even though more, of course, meant overpayment. But property tax, you feel it. You write a check once or twice a year, unless it comes from escrow. And that transparency sometimes creates a hatred of this tax, even though in some ways that's a good thing about the tax. People can judge the value of it based on the benefits they're receiving. And then those exemptions that I mentioned, those are things that need to be addressed within a property tax to make it better. But on the whole, a property tax is very worth keeping. It's a valuable tax. I know sometimes there's opposition to them, but it's a very stable form of taxation. It's a reliable form of taxation that really abides by a lot of the tax principles. It's just a question of making sure that it works for as many taxpayers as possible. With that, I'm going to very, very quickly go to two other taxes, and we're just going to spend a minute or two each on these and then get to some questions because I think we have a few. Severance taxes. These are a tax on extracting value. It generally assumes a relatively non-renewable resource, things like oil, natural gas, and coal. It also applies, though, sometimes to timber or even water. Sometimes these are fairly wide-ranging, and they can be imposed in a variety of ways. Sometimes they're imposed at specific rates on the unit extracted, by 1,000 cubic feet of natural gas or by barrel of oil. Other times they're imposed ad valorem at a price, and which price varies. It could be at the wellhead or extraction point, that price. It could be the spot price on, say, the Henry Hub or some other measure, West Texas Intermediate. There's a variety of different prices that can be used. The challenge with this, there's a trade-off there. Some states have gone ad valorem because in the good years, there's a lot of profits and you can tax this closer to almost like a corporate income type of thing or a gross receipts sort of tax and generate a lot of revenue. When, however, the energy prices plummet, there might still be activity, but there isn't a lot of profits and you see this decline. Now, if this was a corporate income tax, that's what we'd want. But there's already, of course, corporate income taxes on these companies. They're paying some sort of tax, whether it's the corporate or the individual income tax. The logic of a severance tax is that you're extracting something of value. It ceases to exist in that state. You're paying what's almost a royalty for removing that. And that makes much more sense to think about in terms of the quantity removed than the price at a particular point. It's also paying for the environmental costs, the remediation that may be required. There's other ways that that governments require indemnification and bonding in these too, but there are costs that governments incur when severance takes place and the society incurs. And this is supposed to internalize some of that cost. So it makes sense that it's actually done more at a specific price. And that provides some stability as well, because these are highly volatile taxes. And if you're going to rely really heavily on them, it requires some fiscal hedging. Now, if this is a small portion of your base, that may be less important, although you probably want to allow some swings in this. You don't want to fund a major, really important program with it. Maybe it's better to consider it something that goes into the rainy day fund, or maybe it goes into paying down pension liability when it's available. You don't want to fund your schools with this because it can disappear. But some states, states like Alaska or Wyoming or North Dakota rely really heavily on severance taxes. And that requires a lot of hedging. You look at these states and they have rainy day funds or set asides that can be 100% of annual revenue, because they know that there will be good years and there will be bad years. And they need the buffer to continue to pay out all of the government services in the years when you've seen that decline. Alaska, I think, has seen about a 70-80% decline in revenue realizations on oil and natural gas over the last few years. That's enormous, and that can be very challenging and even dangerous for a state. Most states are not going to be in those situations, but you want to think of this as a very volatile revenue stream. It can be a great source of revenue, but you want to prepare for it. And then we'll close really quickly with estate and inheritance taxes, a sort of dying tax, and not just a death tax, but a dying one. There are 12 states plus the District of Columbia that have estate taxes. 6 states have inheritance taxes. Now, that's not 18 states, it's 17 states, because Maryland has both of them. The only state left, New Jersey, used to also have 2 as well, but they repealed one a couple years ago. The difference here, estate taxes are imposed on the net value of an estate, on its total value. The inheritance taxes are paid by the legatees based on their share of the inheritance. Inheritance taxes also care often about the relationship of the legatee with the decedent. A lineal heir will often pay a lower rate than someone who's a little more of a distant relation or is not a relation. A nonprofit receiving it will pay a different rate than some other person or entity. Whereas with an estate tax, it's just a tax on the entire value of the estate. Now, estate planning techniques often enable wealthy individuals to significantly, but not entirely, avoid the tax. State estate and inheritance taxes have different thresholds often than the federal one. At the federal level, only really the wealthiest individuals at this point are paying an estate tax rather. At the state level, that's sometimes also the case, but some of them are lower thresholds. Certainly still well-off individuals, but not always at the same threshold of wealth that you have at the federal level. But those who are subject to it often do have significant resources to be able to plan around it. These can enable them to avoid much of the tax, but it comes at an economic cost in deadweight losses. They can make tax-advantaged gifts while still alive. They can shift assets. They can exploit tax value propositions. They can hedge against some of the expenses at death. Often people move to avoid these taxes. And what's really notable, there's been some research that says that if a wealthy retiree moves from a state 5 years before their death to avoid the estate tax, the state losses are 1.73 times the estate tax revenues, because the state's not going to collect income taxes on them. They're not going to collect all the other taxes they would have been imposing on them. So really the cutoff point is often 3 years. If you 2 to 3 years, if you cause someone to leave 2 to 3 years earlier than they would have otherwise, or when they would have died. Because of an estate tax, it may turn out to lose money. If you're keeping them, obviously, you're generating that additional revenue. But these have high compliance costs. They lead to a lot of outmigration, especially look at the New England states that have lost so many people to other states in recent years, in part because of the estate tax. And they have this significant impact on the economy as people make changes around businesses and around structures. In some cases, this can mean that small businesses have to be split up to pay these bills. The federal government, that's less the case, and the really high threshold ones, that's less the case, but it's still a concern with some closely held businesses that they can be essentially broken apart to pay these taxes. And there used to be something called a soak-up tax, where if the state had the tax, this was a credit against the federal liability. So it really encouraged states to have the taxes up to a certain rate. That no longer exists, and therefore most states have been getting rid of this. You go back a couple decades, every state had an estate tax. Now we're down to 12. And we were at 16 like 3 years ago. We continue to see fewer and fewer states imposing these. They seem to be, again, almost gone. There'll probably be a few lingering for a while longer, but states are starting to get rid of these. They're not seeing the value proposition with them nearly as much now as they used to. So with that very short overview of several taxes, I think I'm going to wrap up the main session. Some of you may have thought we would also discuss excise taxes in this. We had considered having a brief overview of that before a later session on them, but we're going to defer all of that to our fourth session in 2 weeks, when we will look at excise taxes at a much broader level, both the existing types of excise taxes, some of the new ones that are being imposed on things like marijuana and vapor products and sports betting and gaming, and also talk a little about the broader economic theory surrounding those. So I hope you'll tune in both for next week's session and also in 2 weeks for that one on the excise taxes, since we did not have time for those here. Again, I'm going to get to questions in just a moment, but I very much appreciate everyone who tuned in for this presentation. I know we just covered a lot at a very high level, but feel free to follow up with a question. We'll answer a few here, but also if you're listening later, my email address is jmw@taxfoundation.org. Would be happy to field those at any time. So getting to some questions. We have a question about whether the $10,000 cap on the deduction for state and local taxes will lead to more states cutting back on their spending, and whether this changes anything. So on the sales tax itself, probably not much, because if you're familiar with the state and local tax deduction, you know that it is either income or sales and property taxes. You can't deduct income and sales tax. So almost everyone's going to be deducting individual income taxes unless you live in a state that doesn't have one. In that case, you're probably going to do an estimated income imputation based on your income. The federal government provides one where you can convert your income into an estimated sales tax liability and use that, because who, for the most part, is tracking every purchase they make. To a degree, yes, this does increase some tax competitiveness, some fiscal pressure on states. I think at the margin, this will have some effect, but it's probably going to be swamped by much larger effects we're seeing. My personal view is that the rise of remote work, just the ease of potentially creating a dislocation between normal workplaces and where you may choose to live is going to put much more fiscal pressure on states, is going to mean much more tax competitiveness, because those who are really sensitive to taxation, businesses or individuals, have more flexibility than ever before. This is a really marginal thing. Obviously, it's only a handful of taxpayers. I think it has some effect on the fiscal capacity of a state, but it's probably been dramatically overstated. But it does mean that, there's some limits on how high you can raise rates. So you look at a state like New York, where there's proposals of getting to almost a 16% top combined income tax rate in New York City and New York State, and there's only a $10,000 deduction. Yeah, I think that's probably cause for some concern. There was a question also about the difference between a sales and a value added tax, and which I consider to be more beneficial for both consumer and government. It seems pretty unlikely that we are going to go to a value-added tax system in the US anytime soon, although occasionally there are discussions about that. It is actually a pretty efficient form of tax, and there's often misunderstandings about it. It's that weird European tax, and we often think of it pyramiding like a grocery receipts tax, and it doesn't if it's done properly, because again, it's just on the incremental value. It's in many ways a pretty good consumption-based tax, and there's a lot to be said for it. It's hard to harmonize that. It's really hard to do a state level VAT or VAT when you don't have them at the federal level. Canada has moved in this direction some. They have their harmonized sales tax, which is essentially a value-added tax, and a lot of the provinces join in with that. Some of them don't. You could see this happening, but I think we're probably a long ways off from making that change. But if it happened, we'd need to change other things too. A value-added tax is usually a very significant source of revenue. One thing that some people dislike about it, especially those who want lower taxes, is that it can be deceptive. Because it's on so much, relatively low rates are actually really significant drivers of taxation. So people can sometimes think, oh, well, I don't see where I'm paying it. It's embedded somewhere. It's not visible. It's not transparent. The rate's low, when it's actually quite significant. So that's always like this public policy concern. How do you communicate what this tax is? But it can be a pretty well-structured tax if you can do it. But it would probably need to replace other things. This isn't just a replacement for the sales tax if you do it. I mean, this is a replacement for other federal and state taxes we have as well, because it's a pretty big tax. Let's see. So there's a question, why tax property each year instead of just taxing when property's value is realized upon sale? And I think in large part because property taxes are supposed to pay for so many of the basic government services we receive, which we receive benefit from every year that we live somewhere. You as a homeowner receive the benefit from having good roads, functioning court system, the protections of police and fire and all of these other services, from having parks and amenities and all of this. And even when you're not using them, you benefit from them substantially. And like I said, the school system is very important in this as well. So if we just do it when it's on sale, firstly, the rates would have to be way higher, obviously, to capture all of this, but it would really discourage those transactions. It would suggest that we should buy a house and stay in it all our lives. And we really don't want the property tax code or any tax code doing that. And we want this stable form of tax collections. If this is a tax that accords largely with a benefit principle, you should be paying for it as you receive those benefits. In some way, you can almost think of it like your insurance policy. In fact, especially some of the public services that governments provide are. And you pay more, based on the value of your property for those, just like you do with property taxes. And, you have to pay, obviously, on a regular basis, not just when something happens. I have a question about how the property tax works on nonprofits, and it largely doesn't. And this is a huge challenge, especially in places where maybe it's a university town. So the university property is exempt. Religious property is going to tend to be exempt. Hospitals, government buildings, federal and state and local. And that can just exclude a large portion of the property tax base, and it can really raise the rates on everything else. And it's definitely a problem. Some localities have, as I mentioned, gone to these payments in lieu of taxes. Often they're voluntary, which is, you can only get so much voluntary compliance on something like that. But sometimes localities have used a carrot and stick approach to try to get some of these properties to pay. There is probably an economic case for saying that nonprofits should pay property taxes. They are receiving these services as well. There's a pretty good case for why they shouldn't pay income taxes. They literally don't have profits. So, what does it mean to tax the profits of a nonprofit? We want to treat them differently. They are, however, receiving government benefits. Is there a case for taxing them? Yeah. Are we going to? I think that would require a sea change in public opinion. And, I'd be wary of being the one pushing that, because this is just a touchy issue. But there is a clear challenge for some jurisdictions that just have really heavy reliance on the nonprofit sector, and therefore have to raise taxes on everyone else. And this tax shifting is a big issue generally. This is where things that keep the assessed value of residential property artificially low can be really bad for businesses that now have to pay much higher effective rates and can create these competitive dislocations. Got a question about this studies on regressivity of the sales tax with regard to groceries, and what I will do is I will make sure that some of that is posted with the materials for this. And also I wrote a paper on some Utah possible reforms published last year that goes into some of this. You can find it on our website on Utah sales tax modernization. I know it's one state, but you can find some of that research there. Another question, reading this as I go. If a business is selling online, each transaction is taxed according to the consumer state address. Is that correct? And how do you automatically apply sales tax on a transaction based on different destination state rates? The answer is that you don't always do so easily. This is a challenge. Now, a lot of retailers use a variety of different service providers, these third-party entities that help handle a lot of this for them. That's not always cheap. Within streamlined sales tax, there's some options for small sellers to have free access to some of this, but it can be expensive and high compliance to know what the rate is in your destination jurisdiction, not just state, but also the local one. You need that lookup information ideally integrated into your sales system. You need to know if something is in the base, and it's tough enough if that's 50 states, but again, there's services that can help you with this. It's really tough when we're talking about over 10,000 sales tax jurisdictions across the country. So those states that allow that local authority create enormous headaches for small businesses. And there are plenty of people who can tell you with some of these businesses that they spend probably more on compliance costs in a handful of states than they actually remit in sales taxes, which isn't how this should happen, which is why those thresholds, the safe harbors, are really important, why lookup tools are really important, why you do need that unitary administration and uniform base. And we're getting there, and I think you're going to see some more court cases in a couple of the states that have not been fully in compliance. You also just have the case that in some states the compliance isn't happening. Like in Colorado, you have local governments that basically just aren't being able to take advantage of the remote sellers sales tax. And they should be able to, but only if they comply with certain standards that make it feasible, and so that you're not discriminating against interstate commerce, which I think if you impose the current one, you would. I have a question about sharing formulas across sales taxes. And the question was like federal and state, and I think also local. So in the United States, of course, there is no federal sales tax. There are a handful of federal excise taxes, but sales taxes are a prerogative of state governments. But we do have local sales taxes. Most of them are local option. Like I said, they're usually collected and remitted on behalf of the localities by the state, but it imposes, the local rate, and then it just remits it back to the locality. In a handful, however, there are sharing formulas where instead of it being a pure local option, you have some sort of formula based on population or different things that share a portion of the state sales tax revenue with the local governments. North Carolina for a number of years had a population weighted element of its local sales tax. California has some that it shares that way. Utah is an interesting system on this, that's sort of a hybrid system. But for the most part, these are discrete, even if they're ideally collected at the same point. The sales that are sourced to a local jurisdiction are taxable there, and the tax is paid on those and remitted to that government. I think, as I'm looking through these questions, that may answer all of the ones that we have received, and we are already 15 minutes past the hour on the Q&A session. So I am going to wrap it up there, but feel free to follow up with us if you have any further questions. Appreciate all of you who stuck around for an additional 15 minutes for Q&A. Thanks for tuning in. Thanks to everyone who's listening later. We do have 4 more sessions, including one on taxation and remote work, on excise taxes, on the on things like CARES Act conformity, and where states go from here on responding to the pandemic. We have a lot more good material coming up, so I hope that you'll tune in every week. And if you found this useful, please let others know, because it's available both live and for those who sign up as audio and video later. We would love to have more people join, and we hope we can be a resource to all of you. Thanks again. Appreciate having the opportunity to spend some time with you this morning. Have a great day.